We believe so. We see markets as becoming increasingly expensive, and there's lots of risks out there. What will be the risk that breaks the camel's back in terms of disrupting markets from their strong returns over the last couple of years? We're not exactly sure. And to try and guard against that, we think investors are best to take a multi-asset approach by taking a diversified approach to both equities, bonds, alternatives and cash, and blending those assets in such a way where their portfolio is protected against a number of different risks. As I mentioned, we see most markets as pretty expensive at the current time, but we still do see some asset classes, regions and sectors that are still attractive and are going to offer investors some good returns over the next couple of years. Probably the first of those is emerging markets. We think emerging markets offer investors better fundamentals and less stretched valuations. So on that basis, they're going to offer a much better reward for risk. Japan's another part of the world that we like. We really like sort of the corporate governance change which is going on there, and that should lead to higher returns for investors. And I think sort of in the more defensive space, we see sort of the rising bond yields that are coming out of Australia, and with the cash rate likely to stay on hold here for quite some time, Australian bonds could offer some value to investors in that time as well. There's a number of ways investors can sort of access these multi-asset or diversified offerings. First of all, probably for investors with lower amounts to invest is through a managed fund. They can easily do that by sort of just filling out a prospectus and then investing money that way. And for those investors who have higher balances to invest, maybe they can explore sort of a managed account structure, which gives them the direct ownership of the underlying securities, greater transparency, and we think that's a very interesting way for investors to explore getting access to a diversified portfolio. We think sort of taking a combined approach is the best way to go about it. And the reason for that is that we believe that there's certain asset classes which lend themselves towards a passive approach, whilst there's other asset classes which lend themselves towards a more active approach. In terms of passive exposure, we believe getting exposure to Australian bonds through a benchmark type exposure is probably the best way to do that. We think that sort of over the last 5 to 10 years, active managers have done a poor job of delivering active returns after fees. While sort of in terms of the equity space, we think that sort of being able to exploit sort of benchmark weights, whether that be by sector or country exposure, managers who have sort of that insight can deliver strong active returns. So that's a space which we would consider good for active exposure.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.